Now, having looked at inflation in our net present value calculations, let's go on to look at the second important part of NPV from the days of F9 financial management, which is there looking at taxation. Now, remember, when we looked at taxation, there were two impacts that taxation had on our NPV calculations. The first one that we have to go through and look at was looking there at the tax that you pay on your net relevant cash flows. Because you're going to pay tax there at 28% on those cash flows, or whatever rate you are given there within the question. Now, what you have to be careful of there is that you actually read the question. So there, I'll just write the three letters RTQ. So read the question. Why? Well, one, as to what the tax rate is, and two, the timing of that cash flow. Because different questions will have different timings of when tax is paid. In reality, if we're thinking about taxes on companies and corporation tax, the tax is paid for large companies in instalments, or, if you like, maybe 9 months and 1 day after the end of the financial year. We're not going to mess around with that in terms of discounting. We're going to either make assumptions or, more likely to minimise errors in the exam, be told what to do. So things that we could have as examples are the tax is paid at the end of the year to which the transaction took place. So if I incurred £100,000 worth of profit in this year, 28% of that being £28,000, I'd pay the £28,000 at the end of that year, so T1. If, however, we had the same profit of 100, same tax at 28%, so £28,000, and we were told that the tax was paid in the year following, then the tax will be paid there in T2 based upon my T1 cash flows. Read the question. Read it very, very carefully. The second aspect that we need to go through and look at in terms of tax is going through there and looking at the tax relief that we get on your depreciation. To you and I, that's commonly referred to as your capital allowances. You should be comfortable with this from your taxation paper that you've previously seen. You should also be comfortable with it because it was seen in great detail in financial management. Because what you have there is your capital allowances will commonly be there at 25% reducing balance. And then what we'll go through and have is we will then also have a balancing allowance or balancing charge in the year of disposal. Now, I'm not going to go through and give you endless notes about balancing allowances, balancing charges and capital allowances. Again, just read the question. It's something you should be comfortable with. The best way that we can go through and work it is by using the examples. So, what do we have? Well, here we're asked to go through and calculate the net cash flows of the project. So we're not actually going to go through and do any discounting. We're not asked for the net present value, but we're just looking for the cash flows, if you like, after taking account of any taxation. So what do we have within the question? Well, here it tells us how much we buy the asset for. So we buy it there for £10,000 at T0. Now that there, we are told, very importantly, it's in bold and we'll highlight it to emphasise it, is there at the beginning of the accounting period. And just to help us with the dates, we're told there the beginning of the accounting period is the 1st of January 01. We're going to go through and undertake a 2-year project, so we'll need within there T1 and T2 in our analysis. And then we're given there our net trading revenues for each year of £5,000. So there, 5,000 for T1, 5,000 for T2. Told then as well that we sell the asset for £6,000 on the last day of the second year. So that will then go through and give rise to either a balancing allowance or a balancing charge. What we're told here, again, read the question. It tells us there that tax is at 33%. and your writing down allowances are available there at 25%. We're not then told anything about the tax and when it's paid. So what we do is we'll go with the usual assumption. The usual assumption is there that we pay the tax in the year following when the revenues were generated. So if I generate revenues in T1, they'll be taxed in T2. Generate revenues in T2, they'll be taxed in T3. Now that's important because we're going to generate revenues in T2. So therefore we'll need also a column for T3 where we have the tax. So let's go through and look at this first scenario. We've got there T0, T1, T2 and T3. Now let's just move that down ever so slightly, so we'll see why in a moment. We can put some dates in there. But let's go through there and get some of the easy marks. You've got our net trading revenues are there at 5,000 at T1 and 5,000 at T2. We then have our tax on those trading revenues. Now, we're going to take 33% of that 5,000, which should give us 1,650. But we're going to assume here that the tax is payable in the year following when the revenues were generated. So here, what we have is the tax at T1 will be payable in T2. And then there, the tax on the revenues in T2 will be payable in T3. We then have everything to do with the asset. So we buy the asset at T0 for £10,000. We then go through and sell the asset at the end of the second year for £6,000. What we have to look at then are our capital allowances. Now this is where we need to think about the dates. Because what we have is we were told that this asset was bought on the 1st of the 1st, 2001. So there, what we then have 1 year on is the 31st of the 12th, 01, which is the same as the 1st of the 1st, 02. Okay, different accounting period, but for timing purposes, the same cash flow period. We've then got there the 31st of the 12th, 02, which is the same as the 1st of the 1st, 03. And then there, that will be the 31st of the 12th, 03, and the 1st of the 1st, 04. Which makes a little bit of sense because what we've got is if we think that our cash flows arose there, 31st of the 12th, 01 at 5,000, we pay the tax on them at the end of the following year, which is there, 31st of the 12th, 02. But that's not that important at this point in time. What we're looking at now is looking at our capital allowances. So what we're going to go through and do is look at a working. Standard working that we've gone through and seen before. We're going to look there at what happens with a bit of our narrative. We're going to look there at the amount of cash involved. We're going to look at the tax saving at 33% and the important column when that cash flow arises. Because there at T0, we went through there and bought the asset for £10,000. We're going to claim capital allowances at 25%. So that's £2,500. Tax saving on that capital allowances at 33% gives me £825. Big issue there is when does that cash flow arise? Well, let's go back and look at our dates. Because what we did is we went through there, we bought this asset on the 1st of the 1st, 2001, at the very start of an accounting period. Now, what we're looking at there is the tax is going to arise in the end of the year after the transaction took place. So in that following accounting period. Because you've got to be very, very careful. Because The end of the current accounting period is there the 31st of the 12th, 2001. Now we're going to be taxed in the year following the end of that accounting period. So the tax is going to go through and arise there, not at T1, but there at T2. So that tax saving there of 825 is at T2. Be very careful. We then go through, in the next year, we have a tax written down value of 7,500, and what happens there is we won't claim any capital allowances because we've disposed of the machinery. So we go through there and sell it for £6,000. If you like, we've gone through there and made a loss of 1,500. So there, the taxman will allow us that loss as a balancing allowance, and that balancing allowance is there at 33% of the 1,500, giving me there £495,000. And we had the original capital allowance at T2, so that balancing allowance would arise there in the following year at T3. So there, what we have is capital allowances at T2 of 825, a balancing allowance of 495, and what we can then go through and do is total up all of the cash flows. So 10,000 at T0, 5,000 at T1, 10,175 at T2, and then an outflow negative of 1,155 at T3. You could then go through, if you so wish, make up a discount rate, discount it back to present value, but that's not answering the question. It just wanted you to go through and calculate the net cash flows. So, what I'd like you to go through and do now is, based upon that example, so the example that we've just done, there's then another example immediately following, whereby it's all pretty much exactly the same. What we have is we have tax at 33%. You've got writing down allowances at 25%. You buy a fixed asset for the same amount at 10,000. You've got the same net trading revenues at £5,000 per annum. Just be careful, when we scrap the asset, we go through here and scrap it for nil. However, we still go through there and scrap it on exactly the same date, the last day of the second year. However, what's fundamentally important here is when we buy the asset. It's there at the end of the accounting period, which is there the 31st of December 2000. So what I'd like you to go through and do is have a go, work it through and see how you get on. Good luck. So how did you get on calculating those net cash flows? Those figures highlighted in yellow are the ones that you should have got. If you've got them, brilliant, move on. If not, let's just go through, have a chat and see where we may have gone wrong. The question was pretty similar to what we had before when it came to the net trading revenues. The net trading revenues were exactly the same in T1 and T2. Tax rate was the same there at 33%, which goes through there and gives us the tax of 1,650 in the following years, T2 and T3. In terms of going through and buying the asset, we still bought the asset at T0 for £10,000, so no change there. However, what we did change was what we disposed of it for. We scrapped it. So before we had 6,000, now we have nil. What also changed within the question was the date that we acquired that asset. 31st of the 12th, 2000. If you like, just before midnight at the end of the millennium. We bought an asset, we didn't delay it until the next day. That didn't change the time period of when the initial purchase cash outflow took place of £10,000, but it did have an impact on the timing of the cash flows to do with my capital allowances. Again, we've got ourselves there a little working to make sure that we are happy with it. So same approach in that you look at your narrative, the amounts involved, the tax and the time period. So there, what we have is we bought the asset for 10,000, forgive me. Capital allowances at 25% of 2,500. Tax saving at 33 give us 825. However, that now arises at T1 and not T2 like we had before. Why? Well, what we have quite simply there is we bought the asset at the end of 2000. The tax is going to arise the year after that transaction took place. Now, the year after is 2001. The end of 2001 is that date there, the 31st of the 12th, 01, which is there at T1. So the first cash flow that we have in terms of your capital allowances, as we said, is there at T1. And then what happens? Well, then we're going to go through in the next year, 2001, we haven't sold the assets. Be careful. In 2001, we just utilise the assets, so we get capital allowances again at 25%.